Okay, welcome to the June 20th edition of the Fats, Fuels, and Oils webinar. This week, we are going to talk about what's going on with the weather and the growing conditions so far, and the outlook for the crop based on where we are now and the outlook. And then we're going to talk a little bit about the EPA mandates that are supposed to be released this week, and then go through the EMTS data that the EPA released on Thursday. All right, so it's not a huge surprise that that the 7-day and the 30-day both show pretty dry conditions over most of the Corn Belt. And this has, as I've said before, it's still early in the season, so the crops are small, but we're quickly kind of moving out of that phase and of development and into development where the crops will need more and more soil moisture. And so far, crop ratings are sort of notoriously unreliable at this time of the year, but they do offer a way to compare crops across years. However, this early in the season, you don't necessarily get all of the bad years because USDA waits until the crop is developed enough to start rating it. And so like 2019 still isn't included. And we'll get an update this week, I assume, and I think probably most analysts assume that the update will show that conditions deteriorated a little bit more in the past week. It still is, we still are sort of entering this period where theoretically the trend can change. However, currently the forecast is out through July 5th. And while the weather maps kind of want to try to add a little bit more rain the end of June, early July, a lot of that is based on climatology and its impact on the weather models, as opposed to sort of a frontal passage that comes through and generates a bunch of rain. So the market has not taken that little bit of increased rainfall at the end of each forecast period as something that's going to verify. And we've seen soybean prices and corn prices jump. Soybean prices are about $2 off their lows. And that, I think that probably is as important as whatever the weather is doing right now is kind of the market's reaction so far to the dry weather. I thought that there would be a lot of upside risk if the crop was dry because we already have low stocks and Argentina had a drought this year. But I have been surprised, honestly, at how quickly the market has moved back up. And what that suggests is that if this pattern lasts through the summer, that soybean prices and by extension soybean oil prices probably can move significantly higher than they are right now, just because we still have robust demand from the on the product side, both for meal and for oil. And given the problems in Argentina, US exports this year are going to be needed. I talked before about how kind of the US market ultimately probably is going to become a little bit more of a domestic market. But this year, because of Argentina, we probably are going to need as much soybean exports as the US can manage. And so weather conditions are going to, just like they are every summer, are going to continue to remain to be the main driver of the price movement. The only difference is, unlike most years, when we start to take weather premium out in June, we had taken a lot of premium out after the Brazilian crop was made and was so big. And so now we're really adding a lot more weather premium back into the market. And so these show you what the drought monitor from last Thursday showed. You can see it's similar to the soil moisture levels or the rainfall, where really this is kind of the whole Corn Belt is in some level of drought. Most of it is sort of abnormally dry or moderate drought. The only place that you really see extreme or severe drought is in eastern Nebraska. And in Nebraska, a lot of crops are irrigated because they have problems with rainfall periodically. And so while the drought there is important, and even if you're irrigating crops, if it's hot and dry, it's tough to sort of keep up with that. It's probably not quite as bad for the crops in eastern Nebraska as it would be if that extreme drought was centered on kind of eastern Iowa and western Illinois. The one thing that probably is going well for crop development is the temperatures, and it hasn't been extremely hot, or at least it hasn't been extremely hot based on kind of the data that I look at a lot is data that kind of takes the whole Midwest basically and boils it down to one number. And based on the lows and the highs there, it doesn't seem like it has been overly hot so far this year. Now, of course, the summer will get warmer as we get into July, and that will add additional pressure for more rainfall. And in this chart, you can see the typical rainfall that we've had since the 1st of April, and then what we've had this year, and then the forecast going forward. Now, it's important to remember, while the bars for the forecast rainfall look like that significant rainfall, 25 millimeters is an inch. And so what that suggests is that on average, and again, this is sort of all of the Corn Belt, on average, you're going to see less than a half an inch of rain at any point over the next 2 weeks. Now, it does add up to about almost 2 inches of rainfall, which would be kind of normal. But again, this is kind of aggregated data. And so what it suggests is that probably we'll get some rain in some places and we won't get some rain in other places, a bit like we're seeing today, where there's some rainfall kind of a little bit in southern Iowa and a little further south than that. But it's sort of like a single line of storms that's moving through, and they'll probably get some heavy rain, but not for very long. And then we'll require follow-up rainfall to, again, recharge the soil moisture after it's dry for a day or two. All of this ultimately means that we are going to, one, revise our forecasts, so that we started to do that kind of last week. And I talked about, I wanted to be a little conservative, but it doesn't seem like until the weather pattern changes that there's a whole lot of downside risk to the market. We've seen it run straight up way over the November soybean contract is run way over its 200-day moving average, not way over, but it's run over its 200-day moving average. Today, it's coming back down to kind of test that a little bit. And I think that is, until further notice, that's the kind of selling that we're going to see, which is just technically driven and people saying, wow, I've made $2 in the past 3 weeks. I need to take a little bit of risk off the table. But until we really get a change in the weather pattern, that is going to be the mind of the marketplace. And it wouldn't surprise me if the soybean price, and when I say soybean price, I really mean sort of the whole complex kind of goes back and bounces around the 200-day for a little bit and then returns to moving higher, and could get back up to 14. I think it's still a little early to really get up that high. But again, we're the forecast maps now go out through early June or early July. By the end of the week, we'll be pretty close to mid-July, and that is a significant chunk of the growing season. It's not all of it, and it's certainly not the most important part for soybeans, but it is a significant chunk. And there is as much as I've sort of said, well, they're small and they don't need much water, there is probably damage being done, and yields are probably getting cut a little bit by the early season dryness. Okay, so one last chart. There was really a chart that that Joao found that we wanted to show, and we're going to find the data so we can show it next week. And that compared the soil moisture levels across the last several years. And if you look right now, soil moisture levels are lower than they've been since 2017. And in addition, the decline in May was significantly sharper than we've seen. Like, you typically see a decline in soil moisture levels at this time of the year as the ground heats up and the air heats up. It's just kind of natural, even if we do get rainfall. But the decline in May, since we didn't get any rainfall, really was really significant. So we're going to try and replicate that chart next week. In the interim, what this shows is just kind of there are a bunch of models that they use to estimate soil moisture levels, and then what this is they run all the models and then they take the average, and this represents the average. So this suggests that that the drought monitor is probably a little behind, and the widespread drought is a little bit more widespread than that would suggest. I think the truth for the crops is probably somewhere a little bit between there. There certainly are going to be areas that have gotten kind of timely rainfall and probably don't look that bad. And then there are probably going to be other areas that really haven't gotten any rainfall, and the crop looks like it's about to die. All right, let's talk a little bit about the mandates this year, or the mandates this week, the mandates the EPA is supposed to release this week, and what expectations are. And then also I want to talk a little bit about the eRINs and how that's going to impact production here over the next couple of years. So Bob Lane did a sort of an informal survey and talked to people across the industry and asked them about their expectations for the final mandates. And if you'll excuse me and let me look down a little bit, I can get the results. So basically what people are expecting is a 200 million gallon increase in the biomass-based diesel mandate to 2.82 billion gallons to 3.02 billion gallons from 2.82 billion in the preliminary. 470 million gallon increase in the advance to 6.29 billion from 5.82, and then a 720 million gallon increase in the overall mandate to 21.54 from 20.82. So if you think about it, the 720 million gallon increase includes both the includes the advance 470 million. Now, the expectations for the ethanol mandate were unchanged at 15.25, which I think is correct. But the 720 million, which is 250 million above the advanced, should imply an increase in the implied ethanol mandate to 15.5. And I just kind of, I scratched this down. I asked Bob this last week, and I scratched this down just before the webinar. I haven't had a chance to follow up with him, but that part doesn't make a ton of sense to me. There might be an explanation there that I just don't see immediately, but to me, that part is kind of a little strange. the 470 million gallon increase in the advanced mandate and the 200 million gallon increase in the biomass-based diesel mandate, both are sort of, I think the expectations are driven by the fact that there's a lot of capacity that for renewable diesel production that's coming online. The industry doesn't think that the EPA properly reflected the growth in renewable diesel capacity. And so they will raise the mandates. Again, that may be true, and maybe I am sort of defaulting to what I've seen historically, but I just don't know that I think, and I will happily admit I'm wrong when they release them and they match expectations, but I just don't know that that the EPA is super fired up to meet the industry's growth in capacity. And I say that kind of for the following reason. And I've talked to several people about this, and kind of my answer to this question is changed a little bit. But in general, I think the administration wants to get rid of or limit liquid fuel, period. And the adoption of electric vehicles on the passenger vehicle side of the business will ultimately do that at some point. And so then you assume that they have kind of the same goals for trucking and railroad and shipping and maybe even aviation. But I think certainly for the first three, that makes sense. And so if that's kind of their long-term goal, I'm not sure that increasing the mandates to encourage more liquid fuel production is the way that they want to go about achieving that goal. Well, maybe it is in biomass-based diesel is better for the environment than regular diesel. There's no doubt about that. And given the infrastructure right now, there's no way that we can convert all on-road long-haul trucks, railroads, and ships to batteries anytime soon. And so there's the reality of the next 5 or 10 or 15 years, however many years that transition takes. And then there is what their goals are. And so maybe I'm overemphasizing their desire to get everybody into electric vehicles. And so maybe they will want to encourage more biomass-based diesel production, if for no other reason than in the long term, it does seem like that transition for airplanes is probably going to take a very long time. And if you want to encourage airlines or provide the supply for airlines to start to use a significant amount of SAF in their fuel mix, then that's the one way I could kind of see that going through and raising the mandates would make sense. But outside of that, and that seems a little like maybe one step too many. So I just don't quite see it. And I feel like I'm probably going to be wrong on this. I really do. I've spent a fair amount of time telling people that I don't know that I think that the EPA is going to change their mandates. And typically when that happens, whatever I've said kind of turns out the opposite way. So I won't necessarily be surprised, but that's the way that I think about it anyway. The EPA announced that they were going to pull out the mandates for the eRINs, and they had built in relatively large increases for 2024 and 2025 for eRINs. You can see the allocations, 600 million gallon equivalent and 1.2 billion gallon equivalent added to the D3 mandate. So if you back those out, what you get is a D3 mandate that looks like that increases more in line with where it's been the last couple of years than than this big buildup that we had in the preliminaries. There's nothing for 2023. So the impact of the mandates on 2023 is zero. And so it doesn't mean that for 2023, it's not like they're taking 600 million gallons out for eRINs, and then they need to either leave the mandate unchanged or reduce the D3 and increase the advanced or any of that kind of stuff. For 2024 and 2025, it will make a significant difference. And so the question is then, what do they do with that? Do they just take it out and leave D3 alone at the lower levels and then reduce the total and the advanced to offset the decreases? Or do they take it out, maybe reduce the D3, but don't reduce the advanced or the total, which would be an increase in the implied or undifferentiated advanced biofuel mandate? That is probably where I would come down, that's a good way for the EPA to kind of raise the mandates without really raising the mandates, and providing an increase that the biofuel industry can support, even if it's not as an explicit an increase as they would like. I don't know that the EPA is going to be ready to put the eRINs back in 2024 or 2025. Again, based on my conversation with Bob Lane, and I thought he had a really good take on this, but he said he didn't think that they would probably get them back in until 2030 or maybe even 2035. I don't know that it would take until 2035, but I could see maybe by 2030 or maybe sometime after 2025, they put them back in. How they do this though, or how they deal with this ultimately will have a big impact on the outlook for biomass-based diesel production. And I know it's not consistent to say, well, they don't want to raise the mandates at all, but here's a way that they can easily raise the mandates. If I worked for the EPA, or if I was in charge of the RFS program, just me, myself, this is just my opinion, my goal would basically be to try and not get sued as much as I possibly could. And that's a very difficult goal to achieve if you are the EPA, because most of the decisions that you make about the RFS are going to make one side or the other angry, and then they're going to sue you. And they have these aren't frivolous lawsuits. There are laws, and all of the cases that have been brought have been well-founded, and it's just that they are in kind of a tough position based on a little bit how things have developed. When the RFS law was originally written, it relied a lot on cellulosic fuel that just never really developed in the way that they thought it would. And so what happened was we were perennially short production, and the EPA then needed to go back and make exceptions and reduce the mandates from the legislated levels, and that triggered a lot of lawsuits. And so I think that, again, just my opinion, and if I were doing it, what I would try to do is try to provide the increase without necessarily changing things so that it's a big kind of headline increase. Now, of course, the energy industry and the food industry are full of a lot of smart people, and they will understand what's going on. It's not like the EPA is going to do something they're not going to figure it out. But it still is just a little in traditionally, I feel like the way that the EPA has tried to make these changes is in that manner, so that one, maybe it's sort of the old negotiation thing. Maybe everybody's a little bit angry. Maybe everybody doesn't get exactly what they want. And then two, it's not a big kind of obvious change that one side or the other can point at and say that's entirely wrong. So I said all of that because it does seem a little odd to say, well, I don't think they really want to increase liquid fuel, but here's a way that they can do it. The reason that I think that they would do that is kind of that. I'm sure that's not the way that they're thinking about it. But if I ran the EPA, that's the way I would kind of think about it, I guess, which is why I don't run the EPA. All right, let's get into some actual data. So on Thursday, the EPA did release their EMTS data for May, and production was up significantly for biomass-based diesel in basically every area. I've got to go back and when I write the article for this week, I'll kind of sum it all up, but there were not any biomass-based diesel production or imports or foreign generation that I don't think I raised. I think I raised all of them this month just because production was so strong. And you can see the jump in the 55 million gallon jump in renewable diesel production suggests that that more capacity is coming online, and the capacity that is already online is up and running, and we are past the problems that we saw in January and February. And the expansion from here probably is going to exceed what we're predicting a bit right now. And there's two parts to our prediction. Obviously, there's renewable diesel and biodiesel. Biodiesel production was also up a lot. You can see biodiesel production was as high as it's been since December of 2021. And that is a little surprising given that in January and February, we saw yield or margins that were significantly higher. Yields have come down for biodiesel by about half, but still remain historically high. And so I think that's part of what you saw with the biodiesel production, biodiesel imports and foreign generation of renewable diesel were also were higher than our expectation. And so everybody just produced a lot of biomass-based diesel in May, and I would have raised my renewable diesel forecast a little bit more, and it looks a little odd on this chart when we get down to the other charts. The reason that I didn't is, excuse me, the big increase that we saw this month was not quite in line with where our expectations were from a capacity standpoint. And so I want to do a little bit more research, and we're actually going through right now for the long-term forecast. We're going through and kind of updating the open dates and the capacities and all of that for the renewable diesel plant. So I wanted to wait until we're done with that process before I really made a significant change in my renewable diesel forecast. If we weren't going through that right now and everything sort of had lined up, I probably would have increased renewable diesel production a little bit more than I did. But that's where we are. For biodiesel, you can see, actually, if I go back, you can see from this that we've got biodiesel kind of tailing off here through the end of the year instead of its typical pattern of kind of peaking in December. And that's in part because of this change that we've had recently where our outlook for margins isn't as bright as it had been the last several weeks in particular. And now it kind of wants to go down towards zero or at least towards the long-term historical average, let's say that. That depends a lot on soybean oil prices going higher because of the drought this summer, theoretically, and energy prices staying lower. Now, energy prices also rallied last week, and so margins probably increased last week a bit, although the feedstock increase was pretty substantial, so maybe they didn't. But we're assuming that biodiesel margins will come under pressure, and we will start to get some, we will start to see some biodiesel plants shut down. Last week or the week before, there was the announcement that Hero was going to shut down. I just know, honestly, that the consulting work we do, to the extent that that's some kind of market indicator, has shifted from sort of feedstock availability for renewable diesel plants to looking much more at biodiesel facilities, not necessarily in a what do we do with this afterward kind of way, but is that a good investment right now kind of way, which has been a little surprising. But I think that there's a lot of uncertainty, obviously, about what's going to happen with the biodiesel industry and its capacity, and whether it's going to be able to kind of get through this next part. I think the fact that they're out raising money or that people are looking at them suggests that maybe some of the biodiesel producers are going to try and stick around in through this for as long as they can. And if that is really true, then our decrease this year and next year, you can see in 2024, we've got a relatively aggressive decrease in production, will probably be a little bit too pessimistic. The other thing that I just wanted to point out is you can see this is average daily production. You can see both domestic production and imports were significantly higher than they've been. If you look at this in going back a little bit farther, again, biodiesel production was the highest it's been in more than a year or so, more than 2 years, I guess, not quite. And I don't know if this is kind of a let's make hay while the sun shines situation, or if margins in May just kind of happened to line up. Like I said, they had come down quite a bit, but they were still higher than they had been. So there's nothing that you can kind of point at and say, okay, well, here's why we produce so much biodiesel in May, other than, I think if you just looked at margins relative to history, you would probably be more surprised that we hadn't been producing more all along than you would be surprised that where May's total was. This is our outlook for renewable diesel. Again, you can see we kind of have it kind of basically, or I'm sorry, this is for biodiesel. Oh, this was supposed every week. I deleted the wrong slide. I apologize. So this was actually supposed to be renewable diesel. Here we go. Here's renewable diesel. This is, just go back here for just a quick second, just to show you how May's production actually stacked up against the last 3 years. Like I said, it's since December 2021. But you can see we've got it going down over the rest of the year. Okay, renewable diesel. Here again, I probably would increase this maybe a little bit more as we work through our capacity. It doesn't look that far out of line to me one way or the other, but it wouldn't surprise me if we come back and increase it a bit. The one thing that will moderate that slightly is that $1.95, while something that the energy companies would just absolutely love to have on the gasoline crack side, is significantly lower than we saw earlier this year when margins peaked out at 252 in March. And so if margins are going to continue to be compressed, then that probably will temper a little bit the increase in production I have, although again, the week to week or month to month variation in margin, one, doesn't seem to be very predictive, at least in biodiesel, and two, is certainly overshadowed by growth in renewable diesel capacity. And so it really becomes much more a function of how fast is the capacity added, and then how quickly can they get up to speed. All right, so capacity utilization, seemingly my favorite topic. You can see it's a little misleading here because we're using, again, EIA capacity data with EPA production data. I'm going to ultimately rectify this so that we just look at EIA compared to EIA. But right now, you can see the first not filled in circle is from April, since we don't have EIA capacity data for April yet. And then the second one is May. And in general, those are along the trend that that we've shown in this chart over the past couple of months. And we would expect that renewable diesel capacity utilization will remain around this area, maybe increase a little bit through the end of the year. Still think that it probably is low relative to history, although again, you kind of see a lot of variation there, and a couple of months that are over 100%. So you have to take this average with a grain of salt, but this decline seems a bit overdone, and expectations are that that it will come back. If it does, it has big impact on the feedstock markets and feedstock demand. And so that's why I keep talking about this number in particular, is because this really is, to me, if I look at everything, this is the one question that kind of tells me, okay, whether I think that we really are going to need to run feedstock prices up to a spot where we're rationing demand, or we've got enough feedstock and everything kind of fits together and makes sense. On some level, that's, if you look at the supply and demand across a bunch of stuff, ultimately what you're trying to do is to get everything to sort of fit together in a way that everything sort of makes sense. And this is the one piece of that puzzle that doesn't fit together and necessarily make a lot of sense to me, at least right now. We'll see how things go over the next couple of months, and see, as more capacity gets built out and as the growth rate in capacity slows down, if the utilization starts to match up with sort of where we would expect it to be. All right, now this chart is a chart that I show or post in the report sometimes, and I like it because it tries to get at biodiesel production, and by using feedstock and fuel and credit values. And so what I do here is I take the HOBO spread, and then I subtract the RIN values for the HOBO spread, because the lower the number for the HOBO spread, the more production we should get, at least relative to the five-year average. And you can see so far this year, if you look at January, February, March, April, and May, this is based on the EPA's data, that we haven't really fallen that much below the five-year average. And again, May was way above it, but we expect that the increase in the HOBO spread will start to limit production. And by the time we get to December, we've got a fairly significant decrease in production relative to the five-year average. Ultimately, I probably am going to have to raise those that biodiesel forecast, but for right now, that's kind of where we are. This chart, I think, if you look at sort of the trend for all of the dots, it's much flatter than the trend just for the red dots. And so the red dots kind of help me make a point. But if you look at this as a way to really predict production, it's not super accurate. All right, and then my favorite category, the mystery category, which is renewable diesel, domestic renewable diesel production, generating 1.6 RINs. And you can see that we've had a new player enter the that particular fuel category. And so I apologize if you can't, right now my Roomba is emptying. I usually don't do that now, so I apologize. Anyway, there are at least two companies that their pathway generates this RIN, and one of them is a renewable diesel producer and the other is a SAF producer. And so over the past several months, what I have kind of assumed is that this is the renewable diesel producer has gotten their unit up and running. And so they're producing roughly 30 million gallons, 32 million gallons a month. If we get this 54, 55 kind of continues, then I'll assume that that's kind of the SAF producer. Now, the thing about the SAF producer is that they actually have to import renewable diesel to convert it to SAF. And so the May import data for biodiesel should show a 20 million gallons of imports from the sources that company gets its renewable diesel from. If it doesn't, then what I will assume is that the renewable diesel producer, their capacity is actually larger than we thought. I don't think that's true. I do actually think that this probably, I'll be a little surprised if we don't see the 20 million gallons in the trade data, honestly, as kind of it. And every once in a while, I'll show you this chart, which is ultimately only a small portion of overall production, but it's been something that has been a curiosity to me and driven me a little crazy. So unfortunately, you're going to probably have to deal with that until I really get it figured out. So based on the EMTS data, we made some changes to our forecast for biodiesel and renewable diesel production. Like I said, we added to pretty much every fuel category for renewable diesel and biodiesel production, both domestically and on imports. I think the increases were much smaller. Most of the increase went into either biodiesel or renewable diesel. And that's where we are right now on our production forecast. A pretty significant increase from 3.07 billion gallons last year to 4.21 billion this year is our expectation. Now, the mandates didn't increase that much, 1.2 billion gallons essentially. And so this ultimately may build RINs, but like we've talked about before, for various reasons, I'm not 100% sure that building RINs is something that at the margin will crack the RIN market. If we were carrying 2 billion RINs over and then all of a sudden this year we were going to have 10 billion RIN carryover, then that would, I think, might crack the RIN market. But this increase probably not so much. All right, and then this is just a look at the regional profitability of biodiesel production if you only use soybean oil as a feedstock. And I put this up here because if you look at what happened in May, and this may be part of the reason that we saw the increase in production. If you look what happened, you see that most regions saw an increase in May and then a little decrease kind of mid-month. But in general, margins were, again, near the upper end of where they've been recently and above where they have been historically. And so I think that they've come down now and probably or may come down a little bit more as soybean oil potentially gets more expensive if energy prices don't follow suit. And that may really have an impact on production. However, if you are a biodiesel producer and you're making margins that are 30 cents a gallon, you probably still are doing better than you've done most of the time that you have been a biodiesel producer. And if you're a renewable diesel producer and you're making $2 a gallon, let's call it, that's still a really good margin, even if it isn't where it has been over the past couple of years. But it's still probably in the upper end of the actual long-term historic average for renewable diesel production, whatever that is, ultimately will be. One thing that I thought was a little interesting here, and this is just kind of a quirky thing, which is that if you look on this, most of the time that you see the California margins come down and sort of narrow the spread or fall below the other regions, then you tend to get a tick up in all the margins. The last time I put this chart up, we were just at the point where the California margin was coming down and meeting the other margins kind of in March. And I was going to say something about, oh, usually you see margins go up, but I wasn't sure. And they didn't really go up this much as they have in some of the past cases. And so I don't know. I think that's partially just kind of a reflection of, okay, well, the California market, particularly for biodiesel, isn't that big. And so it's kind of where you can send biodiesel to get some extra premium. And if that California market needs it, then it kind of takes it from other markets and leaves those short. And then everybody kind of moves up. Maybe that's what happens there. I don't know. It's a weird thing. Anyway. Okay, so if we look soybean oil and its portion of the total feedstock mix has been coming down the last 2 years, and particularly from the 5-year average. This is because we have started to import a lot more low CI feedstocks almost across the board, but particularly in tallow and in UCO. That is probably going to continue. However, at some point, we are going to hit a spot where we kind of have tapped out the low CI feedstocks, and then pretty much what's going to be left is soybean oil and canola oil to support any further growth in the industry. Calling when that point is going to be is a little difficult. We've got it somewhere near the end of this year, somewhere in the fourth quarter of this year. But that will depend a lot on, again, the changes that I make on the production side and the change in the outlook for feedstock production and prices. I think that that there is a chance that this slides into next year, this sort of crossover of the 5-year average, let's call it. Slides into next year, but I'd be really surprised if it slid a lot more than that. Okay, here is total feedstock use. You can see based on the EMTS data, we're estimating 2.59 billion pounds of feedstocks were used in May in domestic biofuel production. That is the last time I put this chart up here. I had a prediction for April, which was just over 2 billion pounds. And so production or feedstock usage has been significantly higher than our expectations. We probably grew a little bit from April, but still, I'm quite sure that we didn't suggest that we were going to use 2.6 billion pounds of feedstock in production in May. And one of the things that I think will be interesting, we've talked a little bit about it, is to see what happens with canola oil. And you can see in March, the last data that we got, we had 322 million pounds of canola oil. We're going to go back to sort of 200 million going forward, or 200 million plus going forward. Again, based on this idea that canola oil has been relatively inexpensive compared to soybean oil. And so we will start to decrease the usage as that spread widens back out towards its historical norm. So that's kind of why you see a little bit of a decrease there in our forecast from where we were in March. It probably will be a little bit higher than we expect, and so that line there between March and May probably is a little more trendy than it is peaky after March. But we're getting to the point where we are going to start using 1 billion pounds of soybean oil each month in production, and that's nearly as much as we use on the non-biofuel side. So it's getting really close to a 50-50 split between biofuel and non-biofuel. It looks very similar for a lot of these feedstocks, not necessarily the 50-50 split maybe, but growth in biofuel feedstock use that is not displacing non-biofuel use. And that's the reason that I think that ultimately we're going to hit the ceiling on low CI feedstocks. And then when that happens, then again, soybean oil and canola oil will kind of be what is left. All right, and then my least favorite chart is the implied yield from based on the EMTS data. So this is based on the EMTS data and then our estimate for feedstock use in April and in May. You can see in May, like I said on the other charts, you can see in May our implied yield is below 7. And so it won't surprise me if feedstock demand in May is a little bit stronger than the 2.56 billion pounds that we suggest, and that number doesn't get back closer to 7.5 or so. Because we're using 2 different series, you can have some weird numbers. So if it stays at 6.6 or drops a little bit, that will be more a function of the 2 series than a realistic yield, I guess. All right, with that, I've got some questions, and I actually have a meeting today, so I'm going to try and go through these quickly. How much is the EPA expected to increase the blending volumes for biodiesel and renewable diesel? So the EPA doesn't really set out targets for biodiesel or renewable diesel. They just have a biomass-based diesel mandate, and that's the one that went up 200 million gallons to, or that people expect will go up 200 million gallons to 3.02 from 2.82 in the preliminary, but they don't specify this is how much biodiesel we need to blend and this is how much renewable diesel we need to blend. And even the 3.02, then we start to add the undifferentiated advanced and the gap between ethanol production and the ethanol mandate back to biomass-based diesel to kind of get an idea of what we think production is really going to be, or what the mandates imply production should be. Are you adjusting your forecast based on the recent soybean oil spikes, or are you waiting for the EPA outcomes before updating? I'm trying to adjust based on the soybean oil spikes. That's why you see the decline in biodiesel production. I think that's going to be where a lot of that ends up showing up. When the EPA comes out, one, because I generally think that the EPA doesn't change that much from preliminary to final. And 2, it's just impossible to guess what they're going to do. And so I don't really make any adjustments based on my assumptions about what the EPA is going to do. Which hero plants are shutting down? You know, if you send me an email, I will respond to that. Somebody sent me a a Teams message with a story about that. So if I have messed up the company, or if the hero plants aren't really shutting down, I will I'll come on and make a correction next week. I'm fairly sure that's who it was, though. But if you send me an email, I can give you a little bit more detail, or we can set up a time to talk and get more detail. What is your estimated cost of production for biodiesel and renewable diesel? It is, I can tell you roughly, it is, the way that we do it is it's mostly feedstock cost, right? And then we have some assumptions about fixed cost and variable cost that aren't that detailed, at least for the purposes of this stuff. They're not super detailed, and we don't change those. So we don't include stuff like, we don't have detail on like natural gas or any other sort of variable cost. We just kind of assume the same costs, and then this way our margins kind of reflect the trend in feedstock costs and their impact on margins. We are doing some consulting work, and we're developing a much more detailed model that ultimately we will roll into our forecast on this side. We just need to build out all of the back end to kind of feed into it and to get the model all straightened out. But we should have that done here in the next several months. And so I can tell you at that point, we'll have a much better estimate. This estimate, I think, is good for the trend in costs and comparing sort of vegetable oil against fats and greases. So our cost, renewable diesel, let's call it about $5.25, and biodiesel about $6, roughly. And that's more reflective of, I guess, actually, that was earlier in the year. Right now, we'd call renewable diesel about $4.50 and biodiesel about $5.50. Again, that's more reflective of the changes in the feedstock costs between those two periods than it is in anything else. Why don't we consistently see renewable diesel capacity utilization much higher if it's so profitable? So that really is a question, is why don't we should expect that renewable diesel or capacity should be 85, 90%, 95%, whatever it is. I think a lot of it has to do with the fact that there's two parts to it. One, a lot of the plants are new. And so there's a startup period that where they don't run at the capacities that they ultimately will run at. And if they have any issues with pretreatment or anything else, they tend to run a little bit lower. And that kind of has been, because we've had so much growth in capacity, that's been a bit of the issue earlier this year. Now we are starting to see, I think, that capacity utilization move towards where we would expect it to be. There will always be a little bit of, as long as the industry is growing, there will always be a little bit of that. There's a new facility opening that's not really running at capacity. The other thing is that for capacity, the number we reconcile to is the EIA capacity number. And if you've ever looked at the EIA's biodiesel capacity numbers, they do a fantastic job, but the biodiesel capacity numbers, I always felt like seemed a little high to me. Now, I didn't do a survey of all the biodiesel plants in the country, and there are a couple of lists out there that you can kind of look at the EIA and look at theirs, but they seemed a little high to me, and the renewable diesel capacity seems a little high to me. Not that I can't sort of track down where I think all of the plants are that the EIA is including, but that may also have a small impact on the capacity utilization. How are those feedstock number yields? They're not how are those feedstock yield numbers physically possible? They're not. It's just what I'm doing there is I'm comparing the EPA EPA implied production with the EIA feedstock use, or in the case of the 6.6, our estimate of what the feedstock use is going to be. And that's why you get the low number, because you're comparing two series where the production doesn't match up each month, and there can be big deviations in the production from month to month between what the EPA says and what the EIA says. So that's why I don't like that chart that much. And I've got a new chart that I'm going to start to use that is just EIA on EIA, and that should give us a better yield numbers, although we've seen some odd things just in the EIA yields as well. With so much waste oil still available around the world, why do you think additional supplies of low CI feedstock will be exhausted in the near term? And that's a fair point. And it's I guess on some level it is, at what point do prices make those supplies really available in the US, and has the market developed enough so that we can import as much as we theoretically could? And an example of that, I would say, is our imports of UCO from China. Famously, there have been a couple of cargoes that have been turned around because Chinese exporters were just shipping barely heated palm oil. And that's not to cast any aspersions on anybody except for the people that did that. But there is the main feedstock that is available is UCO. And there, at our conference, there were several companies there talking about UCO traceability. Until you really get UCO traceability nailed down, it's going to be not impossible, but it's going to be difficult to get UCO imports to the level that they would be otherwise. And then the other supplies all face the same constraints. Okay, that is all the questions. Thank you, everybody. Always a pleasure. I hope everybody had a good long weekend, and I will see you next Tuesday. Have a great week, everybody. Bye-bye.